These are 10 investing rules which are going to make you rich. Out here, people assume that investing is for the wealthy. They assume that investing is an uphill task. Guys, investing is easy. Investing is a habit which you nurture over time. Start today and be able to grow your investment over time. In case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos each and every day about investing and making money. In case these are the kind of topics which you like, down there is a button called subscribe. Kindly consider subscribing to this channel. Click the button to subscribe for you not to miss any of my videos, because I upload very high quality educational videos each and every day. And I'll still add it. Drop a like on this video. Thank you for subscribing and also liking this video. The very first rule for you is that invest before you spend. What do I mean? Out here, a good chunk of adults are working very hard, of course, but then again, they are unfortunately working for bills. They work on payday, they get paid, they do execute payment of bills, maybe rent of their houses, money for food, maybe school fees. The other amount of money they remain with, they push it to entertainment, you name it. And they are on that particular cycle of living paycheck to paycheck. As part of your bills, also treat investment as part of your bills. That is why you need to invest before spending. When you get your money, have a portion in your budget which are very deliberate about pushing to investment. And even to make it easier for you, you can even automate so that when the money comes to your bank account, whether it is a current or salary account, it is automatically pushed to an investment account. That way, you are treating investing as part of your bills, as opposed to you thinking investing is something out of the blues. That is going to really assist you unlock money and be able to grow your money over time. And then, the second rule for you is that buy great businesses, not just cheap stocks. It is unfortunate how a number of people out here, when they want to invest or buy stocks, they just go to the stock market, for example, Nairobi Securities Exchange. They look at the stocks and even decide, for example, I see the share of Uchumi is 1 shilling, I want to buy it. I see the share of maybe Kenya Airways is 6.8 shillings, I want to buy it. I see maybe the share of Kenya Re is maybe 10 or 11 shillings, I want to buy it. That is not investing, that is gambling. That is why you need to be buying businesses as opposed to just buying cheap stock. How do you buy business? You need to behave like a business owner. There are those things which are called fundamentals when it comes to investing. Simply put, how is a given company's earnings? How has been the earning growing over time, year in, year out? Okay. How is their debt situation? Okay. What is their distinct competitive advantage in their sector? All these are things which you need to be looking at for you to gauge company health or quality company before you put your money down on any company. That way, you're going to be buying businesses as opposed to just buying a ticket or even you buying a cheap stock. And then the third rule for you is that time in the market is much better than timing the market. It is unfortunate how a number of investors out here tell themselves they need to be timing the market. Guys, you will never beat the market when it comes to timing. That is why the survey of investors, once they run technical analysis and fundamental analysis, they understand dynamics around a given stock, they do get in and commit. As long as a stock is not overvalued, right? As long as the things point towards a good company health, this is a good signal for you to get in. Because the truth be told, if you are waiting, for example, for a stock to dip, waiting for the right time for you to buy, it might never come. Let me give you an example. Right now, the stock of BAT is trading at upwards of 580 Kenya shillings per share, right? If you are sitting there telling yourself, you hope that you're going to buy once the stock hits 550 Kenya shillings per share, what if it never depreciates? And I'm asking that question because the same stock, guys, okay, exactly the same stock, about slightly over 1 year ago, start of last year, it was going at 370 Kenya shillings. Come the end of last year, it was going at 460 Kenya shillings. Right now, it is going at upwards of 580 Kenya shillings. That tells you it is appreciating. So if you are sitting there waiting for the right time, maybe it dips before you buy. What if the next time you look at the charts, it is over 600 Kenya shillings per share? That is why it is better for you to spend time in the market as opposed to timing the market. Because timing the market all the time without taking action is not useful to you as a potential investor, okay? And then the fifth tip for you is that ignore market noise. And that is a very interesting rule for you because, guys, out here, what most people don't understand is that in any stock exchange or security exchange out there, price and potential of there being a possible gain only originates when sellers and buyers disagree. And sometimes, most of the time, what happens out there is that it is fear, uncertainty that drives the market. So we have a number of people out there who are constantly spreading information about given securities, given stocks. As a result, contributing very heavily to volatility. Of course, we all understand investor sentiment really drive the market. But the ideal setting is investor sentiment based on fundamentals. That's not always the case. And that is why you need to ignore market noise, because the majority of market people at the market are noise traders. Once you do fundamental analysis, stick to it. Just because there's hype on a given stock, it doesn't mean you need to jump on it. Just because there is hype or negative information about a given stock, yet your fundamentals tells you it is a good stock and you are holding it, it doesn't mean you have to release it, okay? And then the sixth rule for you is diversify, but don't overdo it. Guys, this is a cliche, but don't put all your eggs in one bucket, because out here things happen. In case you put maybe $1,000,000 on one stock, in case of severe depreciation on a particular stock, you'll end up losing your money and even take time to recover. That is why it is good to diversify. First and foremost, diversify within sectors. Don't just diversify, for example, saying diversification is holding many shares. Holding many shares is not diversification. For example, if you have shares from 5 banks, that is not a healthy diversification. Diversification is, for example, having maybe 1 or 2 shares from the banking sector, others maybe from the service sector, others maybe from manufacturing, you name it. Of course, all this need to be anchored on you having done good analysis and research before you jump on any stock out there. And then the seventh rule for you is never invest money in what you don't understand. This is also a cliche, but unfortunately, a number of people out there, that's how they maneuver. They do invest because of rumors. They do invest because someone said something on social media. They do invest because someone sent them a link which is spreading FUD on their WhatsApp. Don't invest in what you don't understand. That is the easiest way of you losing money. And a simple rule, which I typically tell people out there to look at, is ask yourself, in case that particular stock for a company which you've bought didn't exist in that particular trading house or security exchange, will you still buy the business? If the answer is no, chances are you need to re-examine why you are investing in the first place, because most likely you don't understand the business, you don't understand their competitive edge, you don't understand what they do. If you are investing in what you don't understand, you are gambling. That is why you need to do your own research before you invest. That is going to give you confidence and even stick to your own investment strategy, given you're going to be investing in what you know. And then the eighth rule for you is that keep investing even when market crashes. But there is a caveat to this. There are different types of stocks dipping, okay? If one stock specifically dip, typically it's considered an individual stock dynamic dip in case its average of 52-week average is under 20%. But in case there's a wide dip in prices across the market, that is a market crash. Yes, you need to continue investing even in market crashes, because that avails the opportunity for you to buy low, and then you're going to enjoy when the stock recovers and then continue increasing the value of a particular stock or even sell high. That is why, as an investor, don't panic. You need to keep investing even when the market crashes. But of course, also do your own analysis before you jump on any stock, because it might be crashing and it is a very bad stock, which might really make you drain or lose your money, okay? And then the ninth rule for you is that reinvest your dividends. This is a mistake a good chunk of investors out there do. Each and every year, maybe a company pays them dividend of 12%, 10%. They do cash out these dividends thinking it is their bonus. The savvy investors out there do reinvest their dividends because they know that is the easiest way for them to skyrocket growth of their wealth through the power of compounding. They don't cash out. They continue reinvesting for that particular stock to continue giving them more and more money. And that is how you can even start with a simple amount of money and then over years get to tens of millions through the power of you investing and plowing back your dividends, continuing to compound. Let the compounding effect do the heavy lifting for you, as opposed to you cracking your head, and yet you can reinvest your dividends and continue enjoying the benefits, okay? And then the 10th rule for you is that think in decades, don't think in days. As an investor, for you to make meaningful amount of money, think of investing as a marathon. It's you putting down money consistently, in between learning different lessons, factoring them in to your investing, and continuing to move, okay? That is the best way for you to go about investing. Don't treat investing as a 1 day or 1 week affair. Invest for the long term. Think months ahead. Think years ahead. And you're going to see how your patience is going to be rewarded. Those investors who are patient are the ones who benefit the most from investing in the stock market. Guys, those are 10 rules which, in case you adhere to them, you'll be able to see change in how you are investing and also change in your portfolio or your stock. You're going to increase in value over time. What do you think about this video? I hope you got a thing or two from this video. Look forward to catching up with you in the next video. Cheers, guys, and you all take care.